So I think that the market is not at high levels. 16 times earnings, that growth is accelerating. Multiples of companies should be different, should be higher now than they had been before, because you have capital light models. Instead of having to build car plants, you're getting or hotels, you're getting fees from the assets that other people are investing in businesses. So, and that's deserving of higher multiples. And at Choice Hotels, they had $4 billion market value, and they got $70 billion of hotels that other people own that they're paying them revenues to put people in their hotel rooms. So there's different ways like that. And I think that, so my big premise is, our big premise is that the stock market is tied very closely to the economy. And the economy doubles roughly every 10 or 12 years, and that means the stock market should double every 10 or 12 years over the long term. And I can't see any reason why that's going to change. So if you go back to 1960, it's my typical example. The Dow Jones was 600. It's now 26,000. And you look at the GDP of the country, it was 520 billion. It's now 21 trillion. So basically, they both grow 6, 7, 8% a year. 2 or 3% real and 3 or 4% inflation, and stocks give dividends. When last night, I asked my wife, I said, Judy, when we started dating in 1975, so you were a systems analyst. How much was your salary? And she said, $20,000. I said, well, I just looked up, and systems analyst now salary is $80,000. You should have kept your job. But that was 3.5% increase per year. That's the rate of inflation. That's the value. So your value of your money is going down by 3 or 4% a year. That's what it costs you to hire someone who's the same qualifications that it had before. 3 or 4% a year. Look up anything you want and go back, and you will see it's 3 or 4% a year, except for something like land on the ocean, which is probably 7, 8% a year. But I mean, basically 3 or 4% a year. That's the number. And then, so we're doing something. We're taking money that's falling in value, 100% certainty it's going to fall in value. Every single democracy that ever existed done the same thing. And then we're taking that asset that's falling and buying something that's increasing in value. Businesses. So the way you protect yourself is by investing in it. So I was telling her gold. So gold in 1975 was $130 an ounce. It's now $1,300. That's 5.5% a year. And the Dow Jones in 1975 was 1,000, and it's now 26,000. That's 8% a year. Plus, so the stocks are the best play, 1,000 to 26,000. And that's 8% a year compounded, plus dividends, a couple percent more. So it's almost 10% a year.
If you think the market is so closely tied to the economy, if you think economic growth is picking up, then that might be a reason for thinking stocks are going to pick up too. Do you think that's the case?
Yes, and inflation is going to do better, and growth will be faster. Technology is going to be better. So when I sent you before a listing of stocks that we had invested in, and I said that in 1992 we had $100 million under management, and now have $29.58 billion, and we made our clients $27.3 billion in realized and unrealized gains. $27.3 billion out of the 29.5 or 6 is from the gains that we've achieved. And so I happen to think that if we don't have flows, then, and we are getting flows, but if we don't have flows, then I think that we could double our money again next 5 or 6 or 7 years. And if you look at that list of companies, we've made in 15 stocks. I didn't start off to be a long-term investor, and that wasn't the idea. The idea was I was selling research for commissions. And so my idea was, if we're getting, am I going too far in this?
No.
And so we're getting 1% commissions. That they were fixed rates in the 1970s. And so I would invest in Disney and McDonald's and Federal Express and Nike and Mattel and Hyatt and Dalen, which ultimately became from Home Depot. And so I invested in these companies. And my idea was, if I got someone to invest $800,000, buy 1,000 shares of an $800 stock, I would make an $8,000 commission. And I said it didn't take me long to figure out that if I got them to give me an $8,000 commission for buying 1,000 shares of something, $800,000 investment, then if I got them to sell $800,000, I would also make another $8,000 commission. So I was buying and selling. And then I look back in 10 years and I say, oh my God, what a disaster I've been. All these companies that I was recommending initially, look what they became. And I could have been rich, 20,
You should have
30.
been buying the stocks instead of recommending
Buying
other
and
people
holding.
buy them. Right.
That's where the buying and holding comes from. It comes from looking back and seeing to try to find these businesses that can double in size and investing in them and keeping them.